Are you a passive investor in a syndication that maybe has some variable rate mortgages in there? And if you do, then maybe you're concerned about these expiring interest rate caps that are about to happen. And it's going to really shaking up the industry, and it's going to create a lot of distress to operators right now. But I'm going to show you how the same distress can also lead to incredible buying opportunities in 2024. So the message is, don't let fear hold you back. Look for the right opportunity to get involved, and this could be one of them. Hi, my name is Michael Blank, and I help people become financially free with real estate. Here's what's going on right now. We have these expiring rate caps, and they were bought 1 or 2 or 3 years ago, and they're expiring right now. And the problem is that the renewal of those rate caps cost sometimes hundreds of thousands, even millions of dollars to renew. And this was completely unforeseen. And that thing is causing capital calls, which is more money from investors. It may actually result in losses for the investors as well. So if you're in one of those positions, you're probably kind of feeling distressed about it, kind of anxious about it, and because you might be looking at either putting more money in or maybe even considering a partial or complete loss. So what are these rate caps, and how do we get involved in these things? So rate caps were introduced a couple of years ago when basically the entire market had a consensus that rates would start going up. And so this started showing up about 2.5 years ago as an insurance policy against a rise in the interest rate. So, for a $25 million deal, we would have to pay $40,000 for, let's say, a 2 or 3 year rate cap. And what these rate caps do is, let's say, for easy numbers, the interest rate was at 4% at the time. If you have a 2% rate cap, it would start kicking in at 6%. So if it were to go over 6%, then this insurance would basically pay out so that you're capped at 6%. So what we did is we underwrote these deals, at a blended rate of maybe 5 or 5.5% in case it would go up that high. So that's why we did it. Now, why did we use those rate caps in the first place? Why do we have to do that? Why don't we just get fixed rate in the first place? Well, the reason is because a lot of multifamily is in value add deals, and that typically requires more distressed assets that are below 90% occupied. So anything that's below 90% occupied is distressed. Everything above 90 is called stable. So if it's 90% or above, then you can get government-backed loans like Fannie or Freddie Mac loans. But if you're doing something less than 90%, you have to get what's called bridge loans. And these bridge loans are very similar to construction loans, and they're almost always variable rate. They're typically even more affordable than government-backed loans. In addition to the not getting any other kind of loan for it, there's another advantage to them, and that is it makes the exit very flexible. So in other words, you can refinance or exit for any reason whatsoever after 12 months of this loan, which was very beneficial in 2022 and 2023 when we sold properties at an extraordinary profit and only held them for 18, 24 months because the market ran up so quickly. And this allowed us to actually sell these at a huge profit. Had we not had those loans and have to hold on to them for a full 5 years, we'd have ridden them all the way up and all the way back down, and we would have missed the opportunity to sell. So it was actually good that we had those bridge loans. Now, what happened, of course? We had 11 consecutive rate hikes. And so what happened then, and it created an unbelievable uncertainty in the lending market. The risk level went way up, volatility went high up. And so bottom line is when it comes to renew these rate caps, and most of them are coming due in 2024 and some in 2025, to renew that same rate cap I talked about, that's $40,000, that same rate cap now costs $1 million. Now, even the best multifamily operator under the world doesn't have $1 million laying around, because no one underwrote this. And I know this for a fact because no lender would have given any operator loan at all. Had they known that a $40,000 rate cap would cost $1 million to renew in 2 years, no one would have issued a loan. So therefore, no one on planet Earth could have foretold 11 rate hikes in the impact it would have on those rate caps. And that's fundamentally the problem. So what to do about that, right? Essentially what happens is now if this rate cap has to be renewed and it does not, then the operator is in violation of the loan, right? And the lender can call the loan due, start a foreclosure process, whatever. You are in default of the loan. But there's not enough money in the deal. Even the best operators, when they have $1 million or $2 or $3 million in there, it's there for a reason. It was there for construction, for example, or something like that. It could be some reserves, but not $1 million in extra reserves. So what to do? And so the answer to that question is, well, that's a great question. One way to solve it is by, of course, renewing the rate cap, but you don't have any money, so what do? You do capital calls. Capital calls is when you call up the investors and say, hey, I need you to put more money in the deal. We've run out of money. We need to extend this rate cap. But what if investors won't participate? So it's really not an easy problem to solve because this situation really limits your options as an operator. So for example, obviously one is to extend the rate cap. right? So that's option number one. You need money for that. Now, what if I can't or I don't want to? Well, then you refinance or sell. The problem is that refinancing takes time, number one, and a lot of operators are waiting till the last minute to do something, so they're out of time to both finance or sell. But also, in many cases, the prices are down so much that the actual value of these buildings right now is actually at or below the loan proceeds. And this is especially the case if there's an operator who's not operating very well. So if the property is 70 or 80% occupied, the value of that value has gone down since they bought it. Given the 11 hike heights and loan criteria right now, the loan to value has gone down quite a bit. The height of the market was March of 2022 was the height of the market, and because of the rate hikes, the values actually have come down 25, sometimes even 40%. And if you're at a 40% value, then you're probably going to be below the loan amount. And so you can't refinance because the new loan won't pay off the old one. So what do? You can sell, but the same thing, is it enough to pay off the loan? And if you're in a time crunch, right now is not a good time to sell. You really should be riding this thing out. Wait till the market recovers and then you can sell, because now the risk is a retrade. What's a retrade? Retrade is when you're trying to sell it, the buyer knows you're desperate, and they'll say, oh, did I mean 25 million? Oh, I'm sorry, I meant 21 million. And you're like, crap, I'm not doing that. You're like, okay, well, we'll just walk. And you're like, oh my gosh, now I got to start the process over again. So it's not a good time to sell. Option number 4, of course, is to hand the keys back to the bank. So it's a very difficult time for operators who have variable rate mortgages. And not every operator does, or many operators have a part of their portfolio that's affected. Typically, a lot of them were refinanced, right? So if the deal was bought 3, 4, 5 years ago, it was probably refinanced before all this started happening. So there's also fixed rate in their portfolios, but there's going to be maybe a few of them that are going to be affected by this. So they're going through this distress right now, just so you understand what's going on and why it's going on. But here's the silver lining of the same thing. So if you're a buyer, you want to buy an apartment building, or you're a passive investor, you want to look for investing in 2024, this same distress is also going to create amazing buying opportunities. Because what if a value of a building is now below the loan balance, right? So it's like 40% less than it was 18 months ago. Like it seems like some kind of opportunity, right? And so we're going to get a lot more buying opportunities in the year because of this situation. There's going to be some fire sales, and they're going to require maybe short sales or loan modifications to get those deals done, because lenders don't want to lose money. So, and a lot of this stuff is going to happen in kind of the off-market space. So these bridge lenders know these other operators. We're already starting seeing that. Hey, there's this thing in distress. We're trying to do a workout. We don't like this operator anymore. We need to bring someone else in. We get a call. Do you want to take this thing over, run this thing for us, right? So they're going to be happening in the off-market world. I think some lenders are also going to approve some short sales. I think that's going to happen as well. And you're going to see some foreclosures as some operators hand the keys back to some of these lenders. So you're going to see a lot of this going on. Really reminds me a lot of 2008 in the single-family house market, where people just kind of stopped paying their mortgage, hand the keys back, and this bank started taking these properties on in foreclosure, and then you got basically these properties at wholesale prices. Now, coupled with that, the fundamentals for apartments are very strong. They're still very strong. We still have a housing shortage. We can't build more affordable housing, and so that's always going to be the case. And rents ran up like crazy in 2022 and in the early part of 23, and they've kind of relaxed a little bit, but it has not solved the housing shortage. So overall, the demand for housing, unlike office space, is still very strong. So we see in 2024 and into 2025 a major opportunity where we can pick stuff up, pennies on a dollar, in an environment where the demand for this affordable housing is very high. So we want you to be prepared for that. I want you to be prepared for that and get your education, get educated about this alternative investment class, especially if you're looking for deals, get your education. We'd love to talk to you about getting into syndications yourself as an active investor. Check us out at themichaelblank.com. And if you want to book a call with us, you can do that by going to themichaelblank.com/call, and we'd love to help you get started with that. But if you're an investor, a passive investor, maybe you got burned a little bit, or maybe you're looking for alternative assets, 2024 and 25 are going to be really good opportunities to do that. And if that's you right now, we'd love to have a conversation with you. At Nighthawk Equity is our investment firm. Go to nighthawkequity.com/call and schedule a call with us. We have to do that. We have to get to know each other because most of our deals are 506B, which means that we have to have an existing relationship, and a call is the first step in that process. So check us out, nighthawkequity.com/call, and we look forward to having that conversation with you about some opportunities coming up here.